Okay, for our next section, it's section 12-P2. This is where we're going to talk about how do we divide up that partnership income or losses. So again, partners, they're not employees, so they're not getting paid. They're actual owners, right? So that means that there's no salaries that are being reported as expenses on our income statement. They're actually getting paid the income or losses by taking shares of that profit. So their profits and losses of the partnership are divided up based on whatever agreement they set up in that partnership agreement that we talked about in the first video. So there are three common methods that we use to decide how to allocate that income. So the first one is with a stated ratio, and that's where we're deciding percentage-wise what ratio each partner is going to get. The other one is based off of their capital balances. So how much capital do they have in the individual partners' capital balances, and we divide it up based on the percentage or ratio of that. The other one is we could have a combination. We might be looking at how much service a partner does for the company, how much capital they have, and how much the stated ratio is going to be. So we're going to look at all of those. All right, so this one we're going to look at first is the stated ratio. So the stated ratio, also sometimes is called the income and loss sharing ratio, might also be called the profit and loss ratio or the P&L ratio. Different names for it, but they all mean the same thing. It's where we're deciding what percentage or what fraction of the partnership income or loss each partner is going to get. So this is agreed upon in the partnership agreement. So in this example, we're assuming the partnership agreement of Zane and Perez says that Zane receives 2/3 of the income or loss and Perez receives 1/3 of the income or loss. So if their net income was $60,000, that's how we're going to break it down. So the income summary or the net income is going to be put into the income account, except remember before we put it into income summary and we closed it to capital. This time we are still closing it to capital, but to each the individual capital account. So each partner has their own capital account that it's being closed to. So for the first one we're looking at is Zane. All right, well, Zane gets 2/3 of the total net income. This time it's good. It was positive at $60,000. So Zane gets 2/3 of that $60,000. So if we take 60,000 times 2/3, we get 40,000. So Zane is going to get 40,000 of that net income attributed to their capital account. And then Perez is going to get the remaining 1/3. So we could calculate by taking 60,000 times 1/3, or we can just take that 60,000 minus the 40,000 we already calculated, and the difference is going to be Perez's 1/3 amount, or $20,000. So Perez is going to be credited 20,000 and Zane is going to be credited that 40,000 into their partnership capital accounts. That doesn't mean that they're taking it out of the business. Remember, net income goes into the capital account, and as we are putting in that capital, it's going to each partner's account. All right, our next method is based off of the capital balance. So that's where we'd have to look at, okay, well, how much does each partner have in their capital account? And that's going to determine what ratio we use to figure out how do we split up that $60,000 net income. So the capital balances method allocates it based income and losses based on the ratio that's in that partner's capital balance. So we first have to go and look at what is the balance in that capital account before the net income. So we would look at K Zane. We see that the capital balance was 30,000 and Perez has 10,000. That's based off of their initial investments if we look back at that original entry. So we have a total of 40,000. Then we had to figure out what percentage each one has of that total 40,000. So we're going to take Zane's, we're going to take 30,000 divided by 40,000, and that's going to give us a 75% ratio. Then we do the same thing for Perez. We take 10,000 divided by 40,000, and we get a 25% ratio for Perez. So that's the respective ratios of income that each of them would get. This would be the same if it was a loss. If it was a loss, we would still allocate 75% of the loss to Zane and 25% of the loss to Perez. But again, we're using the example where we have a net income of 60,000. So we take 75,000 times 60,000, and we're going to get 45,000 that goes into Zane's capital. And then for Perez, we would take 25% times 60,000, and 15,000 is going to be allocated to Perez's capital. So if we look at that, we can see that we're allocating the full 60,000. We're basing it off those ratios that we set up for the capital balances, and our entry was still the same thing. We're still debiting income summary and crediting capital. So we're debiting income summary for the full net income amount, and we're crediting capital for the respective allocation percentages. Sometimes we can have a situation where it's a combination. So in this example, we have an allocation based off of services, capital, and stated ratios. So the first part says that Zane and Perez have a partnership agreement with the following conditions. So anytime there's income, Zane is going to receive a $36,000 annual salary allowance, and Perez will receive an annual salary allowance of $24,000. Then each partner is given an annual interest allowance of 10% on their beginning capital balance. So we're using the set amount of a salary allowance, and then if there's additional amounts, then they get a 10% part from their beginning capital balance. And then if there's anything extra, they split it equally. So there's 3 conditions that we have to look at to decide how to split that up. So the example they're giving here is that they had a $70,000 net income. So let's look at that one. All right, so we'll begin with the $70,000 of income to allocate to the 2 partners. Next, we provide an allowance for salary of $36,000 that goes to Zane and $24,000 that goes to Perez. We can look at there and we see that we started with a $70,000 net income. After we deduct them, that gives us a remainder of $10,000 to be allocated to the partners. So next, we're going to provide the interest on the beginning capital. So Zane will receive an allocation of $3,000, which is 10% times his beginning capital balance, which was $30,000 if you remember back. So 30,000 times 10% gives us $3,000. And then Perez will be allocated $1,000 because his original balance was $10,000 times that 10%, so he gets $1,000. So that additional $4,000 comes off of that $10,000 we had a remainder, and that leaves $6,000 that we still need to distribute to the partners. Remember, we had 3 conditions. So we satisfied the salaries and the interest percentage, and it said for the third condition, anything that was left would be allocated equally between the 2 partners. So we have $6,000 left to allocate. So we take 6,000 divided by 2. They're each going to get $3,000 allocated to them. So when we look at that, we can then see that they had a total of $42,000 for Zane and $28,000 for Perez that we would allocate to each of their respective capital accounts based off of that net income of $70,000. So we would debit income summary for $70,000, and we would credit Zane for $42,000, and we would credit Perez for $28,000. Let's look at another one. So what if we only had income for, instead of $70,000, we had net income of $50,000. So how does that change this? All right, well, if we look at the first part, we begin with $50,000 instead of the $70,000, like our previous example, and we provide the allowance for the salary of $36,000 to Zane and $24,000 to Perez. After this allowance, we have a negative $10,000 that has to be allocated to those partners. So we have to use that interest percentage to apply them. So we had $3,000 interest for Perez, $3,000 for Zane, and $1,000 for Perez. So we have a negative $14,000 that has to be allocated. So we have $14,000 divided by 2. So there's a $7,000 negative amount that has to be applied equally. So if we took that, we're going to see that instead of getting that full amount that they would have when they had $70,000, that equal allocation is $7,000 each, but it's a negative. So that reduces how much income goes to each partner because there's only $50,000 to distribute. So we can see that Zane is going to have income of $32,000 and Perez is going to have income of $18,000. All right, so the next few slides are covered in the Need to Know video. and you can watch that separately from this video. The last thing I want to talk about is the partnership financial statements. So if we're looking at them, we can see that before we had the statement of owner's equity. Well, now we have more than one owner. So we're actually going to have this, it's called the statement of partner's equity. And it's broken down into the two different partners. And then we can see that total account. So when this business started, we had 0. Right? And then each partner invested. So Zane invested $30,000. So we can see that investment by owners of $30,000 for Zane, and Perez invested a whole $10,000. Then if we go back to our net income where we had the $70,000, we can see that Zane was allocated $42,000 of that. Perez was allocated $28,000 of that. In this example, we add in some additional information where it says that Zane withdrew $20,000 cash from the partnership and Perez withdrew $12,000. So that's also going to be listed, and withdrawals are going to deduct from their capital balances. So we see their capital balances decreasing by the amount they withdrew from the company. So Zane withdrew $20,000, so that leaves his ending capital balance at $52,000. Perez only withdrew $12,000, so that leaves his ending capital balance at $26,000. So our overall capital balance is now going to be $78,000. So this is just an illustration of how it's a little bit different going from a statement of owner's equity into a statement of partner's equity, and which is sometimes also called a statement of partner's capital. But we're just listing each partner separately so that we can see their allocations of what they contributed to the company or the investments, their allocations of income or losses, and then their withdrawals to get to their ending capital. We add those two together, the ending capital, we can see that our total ending capital balance for the partnership is going to be $78,000. All right, this wraps up the lecture portion for Chapter 12. I encourage everyone to watch the Need to Know videos that are provided, as well as the preview videos for each chapter. They're going to be very helpful to you as you're going through and learning how to use the application of the concepts into your practice. Good luck.